Hi friends, Kurt Triebold here from One Tree Hill reporting to you on this week's market update. This week I want to address our current view on equity market allocations and why our portfolios continue to be underweight international markets, in particular international developed markets. Let's break it down into 5 main reasons. Number 1, weaker economic outlook. We expect the economies in Europe to contract more than the United States or Japan in 2020 due to the pandemic. Although Europe has generally done as well in containing the virus, the economic impact of the lockdown appears to be greater there, and its stimulus jolt has lagged that of the United States and Japan. Number 2, international markets are more value oriented. Until more signs of a durable economic recovery emerge, we are skeptical that value stocks can sustain a relative performance advantage over growth. For example, the European index for non-US developed market equities has only an 8% technology sector weighting compared with a 26% technology weighting in the US-based and better performing S&P 500. If you think of two common tech sectors, internet retail and digital media, both technology sectors in the S&P 500 were better positioned for the pandemic than traditional bricks and mortar companies. Again, growth companies, often technology related, have fared better than value companies, which tend to be brick and mortar. Number 3, performance continues to disappoint. International equities have been unable to sustain relative performance compared to the United States for much of the past 10 years. Until the European index can sustain strength for more than just a month here or there, we are likely to remain cautious. Number 4, valuations are not good short-term timing tools. International stocks have not received much help from low valuations in recent years. Valuations generally don't tell us much about the next year or two, so we would need more reasons to reallocate from US equities to international. That said, lower valuations, stocks on sale, have correlated well with long-term returns historically, suggesting strategic investors who are in it for the long haul may benefit from these reallocations. Number 5, structural concerns. Post-crisis deficits and populism may continue to weigh on investor sentiment, consumer spending, and capital investment for the Eurozone. We are encouraged by the recent movement towards a coordinated fiscal response to COVID-19, but once the fire is put out, more coordinated effort will be needed to drive better returns in Europe. As an alternative, we feel emerging markets appear to be a better choice for international weightings in the short term. A few primary concerns, however, to watch out for. Number 1, increasing US-China tensions. Number 2, emerging markets' difficulty converting economic growth into profits. Number 3, political instability in several countries. And number 4, and I think it's a big one, Brazil's inability to contain COVID-19. So for the time being, we take a cautious approach by overweighting US and underweighting international, in particular underweighting European equities. Hope that was valuable. Look forward to doing this again with you next week. Stay well, everyone.